Okay. Welcome everyone to tonight's class. So this is day one of the free masterclass of the 2-day free masterclass on impairment of assets, IAS 36. In tonight's class, we're going to cover a question from FAQ 4861. It's test 3 2017, I think. So if you go to that letter sent and you go to page 68, I think it is Fruity Ltd, and I think that is test 3 2017. How we will approach today's class: we will read through the scenario, and then we're only going to deal with the impairment question. We're not going to deal with the actual required. The actual required wants us to do other comprehensive income. I'm not going to deal with that. I'm only going to deal with the impairment calculation. So what we're going to do, we're going to read the scenario. As we read the scenario, we will answer the question. As we read the scenario, we'll identify any triggers, and then from there, we will calculate impairment. As we calculate impairment, I would explain to you how you go about doing the impairment calculation. So the thinking process, what you need to have a look out for, and all of those type of stuff. But before we get into the required, I'm going to spend just about 5 to 10 minutes giving you an overview of impairment. So what you should know is that impairment, the standard we're dealing with is IAS 36, which is impairment of assets. IAS 36, impairment of assets, does not deal with all the impairment for all assets. Okay, so what's important to take note is which assets is IAS 36 applicable to. So for example, IAS 36, it applies to PPE, it applies to intangible assets, it applies to investment property, but only investment property that is measured using the cost model. So basically, those are the standards that IAS 36 applies to. Okay, there's some others as well, but we're focusing what we know so far. IAS 36 do not apply to financial assets. The reason being is financial assets has its own impairment standard. So within IFRS 9, there's a section on impairment. So IFRS 9 deals with its own impairment. Similarly, inventory has its own impairment details. So in IAS 32, there's a section on net realizable value, that is inventories impairment. So it's very important to take note that firstly, impairment only applies to assets, and then the standard IAS 36 only applies to certain assets. So like we said, all PPE, all intangible assets, and investment property, but not all investment property. Only investment property that is measured using the cost model. Okay, so that's important to take note. The whole purpose of impairment is to ensure that an asset is not recognized on the statement of financial position at an amount that is more than the future economic benefits of that asset. Remember, when you recognize or when you present an asset on the statement of financial position, you are indicating to the users of financial statements that this asset will generate this amount in the future. So that is why when the carrying amount of an asset is more than the maximum future economic benefits, then we will have to reduce that asset. Why? Because an asset cannot be recognized on the statement of financial position at an amount that is more than the maximum future economic benefits. The maximum future economic benefits of an asset is basically its recoverable amount. An asset's recoverable amount is the higher of two figures. It is the higher of the value in use and the fair value less cost of disposal. So just take note of that. When it comes to impairment, the question is, when do you do impairment? That's the big question. When does impairment take place? So the general rule is as follows: that when there is an indication of impairment, only then do you have to test for impairment. So only if there is an indication of impairment do you have to test for impairment. The job of management of a company. So so the job of management of a company, and that will generally be the job of the finance department and the board and so forth, is to assess every single year, to make an assessment every single year to identify if there are any indications of impairment. If they conclude that there's no indication of impairment, there's no need to perform an impairment test. However, if they conclude that there is an indication of impairment, then they will have to perform impairment tests. The impairment test is simply comparing the carrying amount with an asset's recoverable amount. Okay, so just take note of that. There are two exceptions to the rule. So remember, the general rule is you only test for impairment when there is an indication of impairment. If there's no indication of impairment, there's no need to perform an impairment test. But there are two exceptions to that rule. If you have goodwill have to be tested for impairment every single year. Okay, note whether there's an indication of impairment or not. Similarly, an intangible asset that has an indefinite useful life also have to be tested for impairment annually. Okay, so just be aware of that. There are two types of impairment indicators. You have internal indicators and external indicators. Internal is like when there's a flood happens, or there was a burnout, or whatever, something like that. That's an internal, or your machinery is becoming obsolete, or something of that nature. An external indicator is is an indicator, an event that impacts the industry or the economy as a whole. So, for example, as you witnessed, you had COVID-19 would be an external factor of impairment. So you'll have it would be an external factor that that triggers management to assess for impairment. Okay, so just take note of that. Now, the way you do an impairment is as follows. The way you perform an impairment is as follows. You always want to test for impairment on an individual asset. However, if an individual asset does not generate cash flows independently, then you will have to test for impairment for that particular asset as part of a cash generating unit. A cash generating unit is the smallest group of assets that can generate cash inflows independently. So for example, a building that is leased, that building can generate cash inflows independently, so you can test for impairment on its own. However, many other assets cannot generate cash inflows independently. So as a result, you can't test for impairment as an individual asset. You will have to test for impairment as part of a cash generating unit. And remember, a cash generating unit is the smallest group of assets that can generate cash inflows independently. Okay, so that's the quick high-level overview of impairment of assets. Now we're going to go into that question. I'm going to give you from now till from it's 5 to 7 now until 7 o'clock to read that scenario on your own. It's 2.5 pages, which is on page 68 in the template I just shared. And then from 7 o'clock, I will read it, and then we will work through the question together. Okay, so now I'm going to share my screen and we're going to read through the scenario together. You can see it's fairly a complex scenario. So we're going to break it down nicely. So we may not finish, we'll probably follow this on into tomorrow's session. So we'll spend as much time, maybe just break down the scenario nicely and set up the solution. And then tomorrow we complete the solution, but it's just to get you to think. Okay, so it is important not to overthink, but it's also important to make sure you can pick up all the details within the scenario. So remember, in most cases, they can ask you for an impairment question. It's not the only thing they're going to ask you for, but in most cases, they can ask you for an impairment question. And through testing impairment, they're going to ask, you're going to need to know your other standards, which is PPE, which is and intangibles. So for CTA level 1, FAC 4861, you need to cover PPE, intangible assets, and impairment. For CTA level 2, FAC 4863, you must know PPE, intangible assets, impairment, investment property, some more other stuff. I can't remember, I think borrowing costs and so forth. Okay, so just be aware of that. Now, in most cases, what they're going to do, the big part of the question is going to be most likely impairment. Probably 50% of the paper, 20 marks, 20 to 25 marks of the paper will be impairment. And then what they're going to ask is that within the impairment calculation, you're going to apply principles of IAS 16 PPE, of IAS 38 intangible assets. So here is a good example of we must do impairment, and ultimately nothing is asking for impairment. They asked us for other comprehensive income, but the impairment line item is 20 marks out of the 24 marks. So what you're going to know is that through asking you for impairment, you must know everything else. So just be aware of all of that. Okay, so now I'm going to spend tonight reading the scenario and working through certain issues, because I wanted to actually do the entire paper, but I think there's going to be load shedding. So I just need to, I'm going to work through the scenario, and we're going to try to see as far as we can to set up a template for the solution. And then tomorrow we will actually just work through the solution. Okay. So they say the following. Fruity Ltd is a leading player in the dried fruit industry. The company consists of a wholesale division and a retail division. Fruity has a 30 June financial year end. Both the wholesale and retail division generate cash inflows independently. Very important. They're telling you that you have a company, Fruity. Okay, the Fruity consists of two divisions. Well, they just say that Fruity consists of a wholesale division and a retail division. So it's important in that paragraph, you must pick up is like 3 to 4 important things over there. So the picture you must see you have Fruity Ltd, which is the company. Below Fruity Ltd are two divisions, the wholesale division and the retail division. So you must picture that, you must be able to see the diagram. They also tell you that the company has a 30 June financial year end. So make sure you write that somewhere on your exam paper, or wherever you're doing it, because you need to make sure that you are, you keep that in the back of your mind. Okay, it must even be in the back of it, must be in the front of your mind. So just make sure you are aware that you are busy with a financial year end, 30th of June. And then the last sentence is critical. They're telling you the wholesale and the retail division generate cash inflows independently. So what are they trying to tell you? That the wholesale division is a cash generating unit and the retail division is a cash generating unit. So each division is a separate cash generating unit. So what you must understand at that point in time, we never read further yet, but at that point in time, the smallest group of assets that can generate cash inflows independently, which is a cash generating unit, is wholesale and retail. Okay, the next level would be fruity. So just be aware of that. You always look at from the smallest level. The smallest level is an individual asset. If an individual asset cannot generate cash inflows independently, you must look for the next group of assets, smallest group of assets that can generate cash inflows independently. So here they're telling us it is wholesale and retail. Okay, so that's very important. Now let's read wholesale. They say the wholesale division purchases container loads of dried fruit from farmers and then sell these products in bulk to clients. Okay, so what do they do? The wholesale division purchases container loads of dried fruit. So they have containers of dried fruit and then they sell these products to clients. This division has two classes of PPE, namely farmland, which is farms, and machinery, quality assurance machinery. The land and machinery as individual assets cannot generate cash inflows independently. So there you can see they have two types of assets, two classes of PPE, land, which is farms, and machinery, which is quality assurance machinery. So they have two classes of PPE, and they're telling you that each class cannot generate cash inflows independently. Therefore, we cannot impair the assets. We cannot test the assets for impairment on its own as an individual asset. We have to test the asset for impairment as part of a cash generating unit. And remember, a cash generating unit is the smallest group of assets that can generate cash inflows independently. So in this case, the smallest group of assets that can generate cash inflows independently is the wholesale division. Okay. Next paragraph, still under point 1. The wholesale division was acquired from Global Trading Ltd on 1 July 2010. On this date, all of the assets were deemed to be fairly valued. Goodwill of 12,550 arose on the acquisition as a result of the consideration paid being in excess of the fair value of all the assets. The acquisition of the wholesale division constitutes a business in terms of IFRS 3 business combinations. The annual impairment testing performed by Fruity in terms of paragraph 90 of IAS 36 impairment of assets did not result in any prior year impairment of the wholesale division. Fruity is in the process of finalizing its 2017 financial statements and still has to perform the annual impairment tests on the wholesale division. Okay, so there you can see they acquired the wholesale division from another company. Through the acquisition, they obtained goodwill. Now, remember we said you only test for impairment if there is an indication of impairment. However, there are two exceptions to that rule. When you have goodwill and when you have an intangible asset that has an indefinite useful life. In those two cases, there's a third case, but I'm just going to share the two cases. In those two cases, you have to test for impairment annually, whether or not there is an indication of impairment. So that's very, very important to take note. Now, because you have to test goodwill for impairment annually, goodwill cannot generate cash inflows independently. Goodwill will never be able to generate cash inflows independently. As a result, goodwill will never be able to be impaired individually. So if you can't impair an asset individually, you have to perform the assessment as part of a cash generating unit. Now, because you have to test for because you have to test because you have to test goodwill for impairment annually, you will, by default, you have to test the wholesale division for impairment annually. So just think about this. Because goodwill has to be tested for impairment annually, and because goodwill cannot generate cash inflows independently, that means it cannot be tested. Impairment cannot be tested on goodwill as an individual asset. Goodwill has to be tested as part of a CGU. What is the CGU that goodwill belongs to? It is the wholesale division. So therefore, the wholesale division will be tested for impairment annually. Okay, so whether there's an indication of impairment or no indication, the wholesale division has to be tested for impairment annually because the wholesale division includes goodwill. So that's very, very important. Okay, so just take note of that. So the wholesale division is made up of 3 classes of assets. We have made up of 2 types of assets, PPE and intangible asset. PPE has 2 classes, land and what's the other one? Machinery. And then it has intangible assets, and the intangible asset is goodwill. Okay, so that's important to take note. So we have to test this wholesale division for impairment annually. As I told you, there were no prior year impairments. So we just had to do the impairment for the current year, which is the 2017 financial year. So when you know which year you're in, just remind yourself what is the beginning of the year and what is the end of the year. If the end of the year is 30th June 2017, the beginning of the year has to be 1 July 2016. So 1.1, farmland. On 1 July 2014, 2 farms were purchased at a total cost of 408. The farms are subsequently measured in terms of the revaluation model of IAS 16 PPE. Revaluations are performed at the end of the year, and the farms are non-depreciable assets. The revaluation surplus is transferred to retained earnings when the farms are de-recognized. So just to give you some recap over there, this is PPE. Remember, for PPE, initial recognition will be based, you will, when you measure at initial recognition, the amount that you recognize PPE is always cost. But for subsequent measurement, the company has to make select a policy, a measurement policy. There are 2 measurement policies, either the cost model or the revaluation model, and the company can choose. For our purposes, when I say our purposes, I mean for SAICA purposes, revaluation will only be tested for a non-depreciable asset, such as land. And for depreciable assets, it will only be the cost model. In the real world, you can choose anyone. But SAICA has, not too long ago, I think like 3 or 4 years ago, removed revaluation from the syllabus when it comes to depreciable assets. So for depreciable assets, it will always be the cost model. For non-depreciable assets, it's either or, and generally it's going to be the revaluation model. The reason for that is in the real world, most people don't use the revaluation model for depreciable assets. It's just too much time consuming. So now we know there's a revaluation model. Now we must understand any revaluation gain or loss on a PPE asset goes through other comprehensive income. Okay, very important to understand. Any revaluation gain or loss on a PPE asset goes through other comprehensive income. Now, to link this with impairment, when an asset that is when an asset that is revalued has an impairment. So let's say there's an impairment against an asset that is using the revaluation model. The impairment amount must first reduce the revaluation before you recognize an impairment loss. So let's make an example. Let's say the revaluation for land up until 30th June 2017 is 1.5 million rand. And let's say there's an impairment loss against land of 2 million rand. Now remember, if you read IAS 36, IAS 36 says that an impairment loss must be recognized immediately through profit or loss. An impairment loss must be recognized immediately through profit or loss. But then the standard goes further and saying, however, if you have a revalued asset, the impairment loss must first reduce the revaluation up until the revaluation is zero, and then any remaining impairment is recognized through profit or loss. So for in the example I gave you, let's say we have a revaluation on this land of 1.5 million and an impairment loss of 2 million. If this land was not revalued, the full 2 million would have been recognized through profit or loss under impairment loss. But in this case, land is revalued. So before you recognize the 2 million rand as an impairment loss through profit or loss, you must first reduce any revaluation. So the revaluation that you can reduce is 1.5 million. So you're going to reduce the revaluation by 1.5 million. After you reduce it by 1.5 million, revaluation is zero. But now there is still a 500,000 rand remaining. That 500,000 rand now goes through profit or loss as an impairment loss. Remember, as I said, revaluation on PPE is recognized through OCI. So that 1.5 million will go as a revaluation loss through OCI. So just take note of that. This will most likely come through given the fact that PPE is measured using the revaluation model. But you're going to see it in action when we come to, you will see it in action once we come to, once we come to, when we do the impairment calculation. They say the first revaluation was performed on 30th June 2016. The fair value of the farms was determined by using the cost approach in accordance with IFRS 13 fair value measurement. The net replacement cost on 30th June 2016 of both farms is 461. Neither the residual value nor the estimated useful life has changed since the initial assessment. As you can see, from 1 July 2014 up until 30th June 2016, there was a revaluation gain of that difference, 461 minus 408, whatever that answer is, that is the revaluation gain. We're going to have to see now what happens as at 30th June 2017. So if you look at 1.2, machinery, quality assurance machinery. The quality assurance machinery was bought on 30 November 2014 at a purchase price of 1.1 million rand. The initial delivery and site preparation of the machinery amounted to 89,000 rand, and the engineers' professional fees for the initial calibration of the machines amounted to 11,000 rand. The machinery was ready for use on 1 January 2015. So in that paragraph, they are testing PPE. There are two aspects that they are testing over there. Number one, initial recognition. When we're dealing with initial recognition, there are two principles we are interested in. Number one, when to recognize, and number two, at how much. So at initial recognition, when to recognize, that is when you gain control. When do you gain control? When the risks and rewards of ownership transfer from the seller to you, the buyer. Okay, a typical example would be FOB shopping, FOB destination. Okay, so here it's just, there's nothing to worry about. You bought it on 30th November 2014. That is initial recognition. Okay, so initial recognition, 30th November 2014. That's the first question. The second question at initial recognition is at how much, your initial measurement. The rule is all costs, initial measurement includes all costs incurred to bring an item of PPE to a place and condition ready to be used. Well, in order to have the machine, you need to pay the purchase price. In order to have the machine in a place and condition ready to be used, you need the initial delivery and the site preparation. In order for the machine to be in a place and condition ready to be used, you need the engineer's fees. Okay, so all three costs is a cost incurred to bring the PPE to a place and condition ready to be used. So there you got it, the first principle they're testing. How much is the cost of the PPE asset? The second principle they're testing is, when do you start depreciating? You must start to depreciate when the asset is ready for use. Another term they will use, when the asset is available for use. You don't depreciate when the asset is bought, nor do you start depreciating when you actually use the asset. You need to start depreciating when the asset is ready or available for use. So in this case, you start depreciating on 1 January 2015. Take note, we have our year runs 1 July to 30th June. So take note, the first year only has 6 months. So be aware of that. We say the quality assurance machinery is subsequently measured in terms of the cost model of IAS 16 PPE. Depreciation is calculated by using the units of production method. Assume that the quality assurance machinery has no residual value. The estimated total number of units to produce over the useful life of the machine are that 1.5 million. Below are the actual units produced in each year. Okay, so you will know you have to use a units of production method. There are three methods for relating to there are three methods for depreciation. Number one, the straight line method. Number two, the diminishing balance method. Number three, the units of production method. Okay, so in this case, they're doing units of production. So note number 2, retail division. The retail division's assets are subsequently measured in terms of the cost model of IAS 16 PPE. Depreciation is calculated over the asset's useful life on a straight line basis, taking their residual values into account. The 2017 annual impairment testing performed by Fruity Ltd did not result in an impairment of the retail division. There were no prior year impairments in the retail division. So what you know, impairment on the retail division is 0. The reason why so meaning there's nothing, okay, so there's no impairment. So there's nothing to do over there. So the only one we are going to be focused on is the wholesale division. Okay, so let's go to note number 3. So note number 3 is going to be an interesting one, okay? So note number 3 speaks about the factory building. The factory building was purchased on 1 July 2013 for an amount of 2,570,000 Rand. It is subsequently measured in terms of the cost model and is depreciated on a straight line basis over its useful life of 20 years. Taking its residual value into account, the land value in proportion to the building can be regarded as immaterial. It is estimated that the factory building will be sold for 650 at the end of its useful life. Okay, so that is the residual value. The operations of both the wholesale and the retail division are conducted from the same factory building. However, the wholesale division also operates from the farms. The relative square meters occupied by the divisions are a reasonable indication of the proportion of the factory building devoted to each division. The wholesale division occupies 570 and the retail division occupies 380 of the total 950 factory building. So 70 plus 80 is 15. 5 plus 8 is, yeah, okay, so that equals to 950. Okay, so here's an important concept that they are testing. Brace yourself, it's always going to come in. Okay, I don't want to use the word always. I don't like to use the word always because then you think it's always. But in most cases, I think that's a better use of words. In most cases, this principle is going to come in. This, if you read IAS 36, it's a very short section within IAS 36, but very important. This factory building is defined as a corporate asset. Now, IAS 36 defines what a corporate asset is. So IAS 36 says a corporate asset meets two characteristics. So there's no set definition. I mean, there is a set definition. There's no set assets that are corporate assets. It all depends on the structure of the company. So different assets will be corporate assets for different companies. It all depends on the structure of the company. So for you to identify whether an asset is a corporate asset, it needs to meet two characteristics, or let's say two criteria. Number one, the asset should not be able to generate cash inflows independently. So the factory building can't generate cash inflows independently, okay? So it meets characteristic number one. Number two, it does not sit in one cash generating unit. So as you can see, more than one cash generating unit is utilizing this asset. As you can see, a part of the asset is utilized by wholesale and a part of the asset is utilized by retail. As a result, this asset is a corporate asset because it meets two criteria. Number one, it cannot generate cash inflows independently. And number two, more than one CGU is using this asset, okay? So when you have a corporate asset, there's one of two ways you can go. So the first way is that you can allocate the factory building on a consistent and reasonable basis to the CGU that you are looking at. What is the CGU that we're looking at? We are looking at wholesale division, okay? Now we know wholesale division don't house the full factory. Wholesale division only utilizes part of the factory. So the factory building is a corporate asset. The question for the wholesale division. So the question you need to ask yourself, can the wholesale division reasonably and consistently allocate some percentage of the factory building to the wholesale division? If the answer is yes, then you do so. In this case, the answer is yes. You can allocate a portion of the factory building on a reasonable and consistent basis. So we can do that. If you cannot do that, there's a separate set of criteria that you need to follow. Okay, so I will explain that criteria when we deal with this corporate asset. If I'm going to explain it now, you're just going to get confused. But what you all you need to know by now is what makes something a corporate asset. So this factory building is a corporate asset. Why? It cannot generate cash inflows independently, and relative to the CGU we are reviewing. Which CGU are we reviewing? The wholesale division. So relative to the wholesale division, that factory building is not wholly within the wholesale division. That factory building is also used by another CGU. Okay, so just take note of that. So that makes the factory building a corporate asset. The second thing you need to just be aware of, what you must know now, is that when you do have a corporate asset, there are two ways you can treat a corporate asset. The first one is you basically ask yourself the question, can the corporate asset be allocated to the CGU that you are looking at on a reasonable and consistent basis? If yes, you do that. Like in this case, the answer is yes. So we're going to treat it in terms of whatever we need to do over here. And the other option is no. If it's no, it is a bit more of a, there's some extra steps we need to follow. So when we get to that part of the scenario, or when we get to that part of the calculation, I will explain to you, I'll reiterate the corporate asset issue, I'll reiterate the two directions, and then I'll do the one based on this scenario, and then I'll explain to you how you would treat it if you could not allocate it on a reasonable and consistent basis. Okay, so I'll explain that just now. So it's very important. It's going to come up quite often. And why it will come up quite often? Because if you have the SAICA handbooks, if you do have the SAICA handbooks, what you will understand is that in the SAICA handbooks, in IAS 36, they will tell you to go look at an illustrative example. In the version I have, it is illustrative example 8, and they explain to you how it gets dealt with. The fact that it's in the book and it's tested within our syllabus, they will most likely always bring it up. So just make sure you read that illustrative example if you want to gain some idea. But I'm going to explain to you how to do it. But I want you to know what makes something a corporate asset, and then the two ways you must treat a corporate asset. And then I'll show, when we get to the solution, I will show you the two ways to treat it. So here they told us we can allocate on a reasonable, consistent basis. So all we're going to do, we're going to take 2750. We're going to take, we can't take 2750. Let's just assume 2750 is a carrying amount. So whatever the carrying amount is at 30th June 2017, let's assume 2.5 million. Then the wholesale division will say carrying amount, I'm making up a number, 2.5 million, multiplied by 7,570 divided by 950. So that is the portion of the factory building that will be allocated. To the wholesale CGU. So when you can consistently and reasonably allocate a portion of a corporate asset to a CGU, you must do that. You need to allocate it to the CGU when you want to determine its carrying amount for impairment purposes. However, if you cannot, then there's a different way we'll have to follow, and I'll explain to you when we come there. So now we come to note number 4, value in use and fair value less cost of disposal. When you see value in fair value less cost of disposal, or they're telling you this is your recoverable amount. Remember, an asset's recoverable amount or a CGU's recoverable amount is the higher of value in use and fair value less cost of disposal. So it goes as follows. During June 2017, a new competitor entered the dried fruit market. This resulted in a decrease in the demand for the wholesale division's products. Okay, so there is an indication of impairment, so we'll have to perform an impairment test. As a result of the new competitor, the future cash inflows of the wholesale division are expected to be 632 per annum for a period of 5 years. Assume the cash inflows will occur at the end of each year, and an appropriate post-tax discount rate on a similar asset is 9.05%. Okay, so remember, for a value in use, the rules of a value in use is as follows. When you calculate a value in use, your explicit period must be limited to 5 years. Okay, so if you read I-36, they will tell you there's a heading called value in use, and it's quite long, and they will tell you how to compute. One of the sections is how to compute the value in use. Okay, so I'm going to give you a few of the critical principles. So one, in no particular order, but one, your explicit period should be limited to 5 years. If you want to use more than 5 years, you need to be able to justify it. So just to be safe, you use 5 years, okay? And then any period beyond 5 years, because remember the value in use should basically equal the useful life, the remaining useful life of the asset. So any period beyond the 5 years, you must have a terminal value in year 5, okay, like you do a free cash flow calculation. Secondly, your discount rate that you use needs to be a pre-tax discount rate. Here they gave us a post-tax discount rate. So they're correctly using 5 years, so we're happy with that, but they're giving us a post-tax discount rate. In financial management, when you do the weighted average cost of capital, then we use a post-tax discount rate. But for financial reporting, for accounting, we must use a pre-tax discount rate. The reason for that is accounting accounts for tax separately. There's a separate line item in the income statement called income taxes. So therefore, we need to use a pre-tax discount rate. Most often they're going to give you a post. You must know you must use a pre-tax discount rate. So this is equal to 72%. So to get it to 100%, you just say 9.07 divided by 0.72, and that will give you your pre-tax discount rate. Okay, they're telling you, assume that neither the residual value nor the estimated useful life of any of fruity assets have changed since the new competitor entered the market. Okay, so we're happy with that. Here they're telling you brokers indicated that the wholesale division could be sold at a price of 2 million on 30th June 2017. Any brokerage costs relating to such a disposal will amount to 2225. So as you can see, this is basically your fair value less cost of disposal for the wholesale division. And this information over here is going to be the value in use for the wholesale division. We want the recoverable amount of a wholesale division. Why? Because the impairment test needs to be performed on a CGU level. We can't perform the impairment test on an individual asset level because an individual asset cannot generate cash inflows independently. So the value in use and fair value less cost of disposal amounted on 30th June. Okay, so the wholesale division, as you can see, we must go read. They gave us information to calculate that. Then they're giving you the value in use and the fair value less cost of disposal for the farms. There's no value in use for the farms. That makes sense because they told us in note 1 that the farms nor the machinery can generate cash inflows independently. So because they can't generate cash inflows independently, you can't calculate a value in use. Okay, but they're giving us a fair value less cost of disposal. Then we have quality assurance machinery, and there we can see it is 706. Okay, what is this going to be? This, the accounting standard tells you that you need to perform an impairment test on an individual asset. However, if the individual asset cannot generate cash inflows independently, you need to test the particular asset for impairment in terms as part of a CGU, the smallest group of assets that can generate cash inflows independently. That is why we're going to test the CGU wholesale division for impairment. Once we get the impairment, we'll have to allocate the impairment to each individual asset. Okay, so that is how it works. You test a particular asset in term. You test the CGU for impairment, and you get an impairment loss. You take the impairment loss and you allocate it to each individual asset based on a pro rata basis, based on their carrying amounts. So now you will have a carrying amount after impairment. So what the standard then tells you, and we will go through all of these steps again, what the standard then tells you is that once you have a carrying amount after impairment, you need to compare your carrying amount after impairment to the individual assets recoverable amount. So remember, the individual assets recoverable amount is the higher of value in use and fair value less cost of disposal. Okay, then the other give us a retail division. We don't really need it because they told us nothing to do with it. And then here they're giving us the factory building. The value in use of the factory building is equal to the fair value less cost of disposal. So we need to compare that to the factory building's carrying amount. Okay, so we will look at that when we get there. Here they tell us it is the policy of Fruity to perform any annual impairment on the last day of the relevant financial year. The normal income tax rate is 28%, and the capital gains inclusion rate is 80%. Why is this important? This over here, the statement is important because the accounting standard says for assets that need to be tested for impairment annually, you need to test for impairment annually at the same time every year. Annually does not have to be the last day. It can be any time during the year, but each year it must be the same time. So that is why they're just telling us that it's at the end of the year, so that when we do our impairment test, we base it at 30th June 2017. Remember, in the real world, it could be any other date. It doesn't have to be the financial year end. Why is that? Why do we do that? Because it is impractical for a company to test all the assets for impairment at year end. They'll never finish. So that in order to make sure that they will be in time to have the results ready, they can do it throughout the year, but each year the same asset or the same CGU must be tested for impairment at the same time. Okay. So that is the impairments. Okay, so now we will deal with the impairment calculation. So I'm just going to set it up because I think we're going to have load shedding soon. So I'm just going to set up and then I'm going to show you and then we'll do the actual calculations tomorrow. There's no point in starting the calculations now because we're going to have to redo it again tomorrow. So I'm just going to set up so you can see what we're going to be doing, and then we will do the actual calculations tomorrow. While I get PPE, while I get the Excel, do you have any questions you'd like to ask? So the way we will test for impairment is as follows. So we need to do an impairment test for the wholesale division, okay? So we need to test for impairment as a wholesale division, okay? So and the wholesale division is a CGU. So what do we want? When you do an impairment test, you must compare the carrying amount of the thing, the asset or the CGU you are looking at with the recoverable amount of the asset or the CGU you are looking at. Because we are looking at the CGU, you must compare the recoverable, you must compare the carrying amount of the CGU with a recoverable amount of the CGU. We will come to a corporate asset just now. So the definition of a residual value, if you read IAS 16, they will give you the definition of a residual value. And they just said the residual value is basically the amount that you will receive for the asset at the end of its useful life. A little bit more specific than that, but basically it means, so that is why the resale value I told you is your residual value, because your residual value is basically the amount you will receive for the asset at the end of its useful life. Okay. So impairment test of the wholesale division. So we're going to have carrying amount. Now, the carrying amount of the wholesale division will be a number of assets. Okay. So the first asset was farm, we're going to call it, which was land. The second asset was machinery, which was the quality assurance machinery. Then we must not forget there was also goodwill in this CGU. And then because we have a corporate asset, and the corporate asset can be allocated to the wholesale division on a reasonable and consistent basis, we'll bring in the factory as well. If the corporate asset could not be allocated to the CGU on a reasonable and consistent basis, we will not bring the corporate asset in. Very, very important, okay? So when you identify a corporate asset, remember, how do you identify if an asset is a corporate asset? If the asset cannot generate cash inflows independently, and secondly, if the corporate asset is used by more than one CGU. So in this case, the factory building is used by both the CGU, by both the wholesale division and the retail division. So therefore, it is used by more than one CGU, and it is an asset that cannot generate cash inflows independently. As a result, it is a corporate asset. So when you have a corporate asset, you need to ask yourself, can this asset be allocated on a consistent and reasonable basis to the CGU under review? What is the CGU under review? For our purposes, it is wholesale division. So the question you ask yourself, can the factory be allocated to the wholesale division on a reasonable and consistent basis? In this question, the answer was yes. They told you it can. So when the answer is yes, then you bring the corporate asset in as part of the carrying amount of the CGU. If the answer is no, then you can't bring the corporate asset in as part of the carrying amount of the CGU. Very, very important. Okay. So over here, I don't think I missed any other asset. I'll just make another line just in case I did. If I remember correctly, there was farms, there was machinery, there was goodwill, and then there was factory. So point number one had farms, and it had goodwill, and it had machinery. Point number two was the retail division. Point number three was the factory, which was the corporate asset. Point number four was, okay. So yeah, I think I brought in all the assets. So this factory is a corporate asset. The reason it forms part of the carrying amount of the wholesale division is because this corporate asset can be allocated to the wholesale division on a reasonable and consistent basis. If it could not be allocated to the wholesale division on a reasonable and consistent basis, we could not bring the factory in. Okay, so that's very important. Okay, then we're going to have our carrying amount. Then we want to have our recoverable amount. Now remember, the recoverable amount is the higher of. The recoverable amount is the higher of fair value less costs of disposal and the value in use. Okay, so the recoverable amount is the higher of those two. Okay. Then we will have an impairment loss. Okay, so remember, you will only have an impairment loss if the carrying amount exceeds the recoverable amount. Why will you have an impairment loss? Because remember, if the carrying amount exceeds the recoverable amount, then that means the carrying amount that is recognized on the statement of financial position is more than the maximum future economic benefits. However, if the carrying amount is less than the recoverable amount, then there's no impairment. Okay, so just be aware of that. Okay, so we will compare carrying amount to recoverable amount, but that we will start on tomorrow when we come back for day 2, because I think I'm going to have load shedding now, and then I don't want to start it and then redo it again. So we will come back and work out the fair value less cost of disposal. We will work out the value in use. Once we have both answers, then we can take the higher, and the higher will give us the recoverable amount. Then the carrying amount, we'll have to work out the carrying amount of the farms. We'll have to work out the carrying amount of the machinery. We have to work out the carrying amount. We'll have to work out, okay, goodwill was given to us, so we can just plug that in. And we'll have to work out the carrying amount of the factory. The sum of all of those will give us the carrying amount of the wholesale division. We will compare carrying amount to recoverable amount. If carrying amount is greater than the recoverable amount, there will be an impairment. Okay. Okay, once you have an impairment, then we will have to do an allocation. Okay, so allocated as follows, and we will. So the rule is as follows. This is the following rule. You must first allocate impairment against goodwill. Okay, so if you have impairment, you must first allocate the impairment against goodwill as far as possible. If goodwill is 0 and there's still a remaining balance, then that remaining balance will have to be allocated to the assets, to the remaining assets on a pro rata basis based on their carrying amounts. Okay, so then we will deal with that. Remaining assets. Okay, so I'm going to stop there for today because we will have to, we're going to do all the calculations tomorrow, which will take a good hour and a half or so. Because remember, I'm going to take a bit slow. I'm not writing an exam. In an exam, you have to do this in an hour. I'm going a bit slow because I'm not writing an exam. I'm here to teach it to you. So that's why we will probably spend an hour and a half on the calculations. So come prepared for that. So I'm going to stop here for tonight because there's no point going on for the next 7 minutes. So lights will probably go out. So before I end the lesson, is there any questions from your guys' side? Any questions? If there's no questions, then you are good to go. So I will end the lesson now. If there are no questions, then we're good to go. Okay, guys, good night then. Bye-bye. Okay, wait, there is a question. Oh, no, there isn't.